volatility and put skew strength. This is not skew SKEW like, like marketplace skew. This is, we're really talking about put skew. All right, Tony. So we're going to
Okay.
look at how volatility, when market volatility is low, like it is now, what put skew does and what the market's doing. When volatility is high, what the market's doing, what put skew does.
Okay.
All right.
Mm-hmm.
So let's take a look. For a put and call, the same distance out of the money in most underlyings, the implied volatility is higher for the put. All right. I mean, this doesn't apply to some stocks like growth stocks, and it doesn't apply to some commodities. But generally speaking, if you're talking about all the indexes like the S&P, puts are more expensive than calls. That's it.
Sure.
This feature of the market is called put skew, and it's a key way in which real markets differ from the Black-Scholes model. Today, we're going to examine the effects of put skew and whether it's more pronounced in high or low IV environments. We're currently in a low IV environment. The degree of put skew, meaning how much more implied volatility increases going below the spot price than above, is difficult to express as a single number, as it is the steepness of the curve. But in order to keep with efficient market hypothesis, two things should be observed when the underlying has more put skew: the more frequent up moves than down moves, and the larger down moves relative to the up moves when they occur. Let me repeat that because it's important to this segment. The question becomes, when you have more put skew, what happens with that? Is it more frequent up moves than down moves? And are the down moves larger relative to the up moves when they occur? And that's what we're looking at here. And that's a little bit of the whole takeaway from this segment. So we did a study, 8 years of data in the SPY, IWM, and Qs. Now, each one of these is going to be pretty similar because the correlation between these indexes is like 0.8 or 0.9. So it's not going to be crazy different. But in case people wanted the numbers from each one, we did each one.
Mm-hmm.
We examined the direction and the size of a 30-day price change, of the 30-day price changes. And we separated the results based on implied volatility being above or below 30 at the beginning of the 30-day period. Right now, we would be in the situation when the IVR is below 30.
Sure, easily.
And we examined the direction and the size of the 30-day price changes. Okay, 8 years worth of data. All right, here we go.
Let's bring it.
Drum roll, please. So the first one is the SPY. And like I said, the other ones are going to look very similar to this. And the takeaways here are tough. Overall, up move frequency, it last 8 years, 67%. The mean up move is 3.4 and the mean down move is 4.1. Now, does that mean anything? I don't know. I couldn't tell you how to take away anything.
I mean, these are just facts, right? I mean,
they're just numbers.
Right.
So when implied volatility is greater than 30, we have less frequent up moves. And when the implied volatility is below 30, we have a lot more up moves.
Mm-hmm.
So what you're seeing right now is classic. Market's going higher, volatility is contracting, IVR is dropping. 71% of the time we're going to see up moves. And versus, down moves only 59% of that 30-day period. The mean move right now is, though, it's going to be smaller. And the mean down move is going to be smaller. So you have greater chance of an up move, but the up moves are smaller and the down moves are smaller. When implied volatility rank is higher, you'll have less chance of an up move, but when you do have an up move, it's greater, and so are the down moves. Over 30 and under 30, they're a lot closer. There's less difference between these, but overall, it's kind of the same type of numbers.
Mm-hmm.
Qs are going to be very similar to the SPY because they have a higher correlation. And what you can mainly see is that when you look at the Qs and the SPY, that they are extremely similar, except the Qs have more risk because they have higher volatility. That's my takeaway from that.
Okay. Okay.
And they're basically just trying to explain here that when the markets go down, they go down at a greater velocity, although albeit less often, and they go down less in low volatility than they do in high volatility.
Mm-hmm, mm-hmm, mm-hmm.
As expected, higher implied volatility tended to associate with larger underlying movements. In all those cases, SPY, Qs, and IWM, when implied volatility rank was over 30, the moves were significantly larger. For each of the underlyings, consider the put skew appeared to be more pronounced in low IVR than in high IVR. What happens there is that 73%, that 71%, and that 64%, those were the put skew numbers, and they were definitely much bigger when implied volatility was lower. Up moves were more common out of low IVR. We talked about that. And the size of down moves relative to up moves was larger starting from low IVR. Okay. So to capture this in your trading, consider moving. And this was the observations from our research team from this piece of research. To capture this in your trading, consider moving the short call strikes closer to at the money in low IVR, which we already do, and using more symmetric strikes when trading in high IVR, which is interesting because it's the first time we really came to that conclusion. So what that means is in high IVR, like going to kind of strikes that are kind of more equidistant, and in low IVR, going closer to at the money with your short call strikes. These results are somewhat particular to the 30-day time frame, making them more useful to 45-day trades, especially when managed at 21 days, but more research is required before using them on the 0 DTEs or the 365, DT style trades, because this is 30, 45 days, managed at 21 days type approach. There's actually a lot in there.
There is a lot in there.
Essentially saying that put skew is higher in low IV environments, and it's lower in high IV environments.
You're seeing that right now in the low implied volatility, how puts are so expensive. You were just talking a moment ago about how on a confirm and send, how puts were being priced higher relative, and some people wrote into me and said it's because public likes to buy puts for protection.
Yeah. John, if you go back to slide 3 for a sec. So you can see here, the puts are basically 20%. There's 20% more put skew in low IVR than high IVR, 71 to 59. And that was kind of like their, the overall conclusion is that when you have low IVR, there's less movement, but your puts are there's about 20% more put skew.